One of the most common questions that Brian and I get asked on social media is how to go about building a portfolio. How many stocks do we own? What's our time horizon? How do we go about adding them and what allocations? We're going to walk through our investing philosophies in this video. Thanks to Quarter for sponsoring today's video. All right, Brian, we want to build an investment portfolio for ourselves. What's the very first step?
Well, Brian, the starting point is actually so simple, some people might even skip over it, and that is to define what it is you're aiming for by investing in the first place.
What is the reason that you are putting capital into the stock market? What's its purpose? And when do you need to use that money? That's a really, really important question that you need to know the answer to. I know some investors personally who actually write these down into an investor policy statement, and that guides their decision making around the concept of building a portfolio. Brian, so walk us through your time horizon and your investing strategy.
All right, so I take the time horizon of at least 10 years, and I'm investing, yes, to give my family financial flexibility in the future, but to be honest, the thing that really drives me is testing my own ideas and beliefs about anti-fragility in the real world by investing in companies that share these characteristics.
My investing time horizon is very similar to yours. It's at least a 10-year outlook. And I am personally investing in order to grow my wealth so that I can make my personal finances as bulletproof as possible. To do so, I keep my personal finances hyper conservative. That allows me to put my investments into hyper aggressive stocks. Now, I am not necessarily a completely aggressive stock investor. I am trying to fill my portfolio with high growth companies that have a low business risk.
Now, what you're about to see might sound like we're giving you hard and fast rules for how to build your portfolio.
That's actually not the case at all. What we're about to discuss is the guideposts that we use to construct our own portfolio. These are not hard and fast rules that we follow to the T, but we do think it's important to use them so that we can guide our decision making about asset allocation. All right, Brian, let's say we're researching a stock from scratch and both of us are very excited about it. How would you go about initiating a position in a company?
Brian, I've developed a rule that I call the gut plus 2 weeks. If we run a stock through my framework and I'm excited about it and do some research on it, that's great. But too many times I've been excited about a company, made a big purchase, and ended up regretting it. Because of that, I give myself 2 weeks to cool down. And if I'm still excited about it, I'll make a purchase. How much? I like for my initial purchase to be between 1 and 2.5% of my portfolio, depending on my level of conviction.
My approach is actually very similar to yours, Brian. We have a natural built-in waiting period because both of us are contractors for the Motley Fool, and we have to go through their compliance rules before we can make any purchase. But in general, when I get really excited about a stock that scores very well in my framework, I typically wait about a week before I make my first purchase. And my initial purchase is about 0.5% to at most 1% of my portfolio. So I like to ease into positions very slowly. All right, Brian, that's our initial position. How do we go about adding to a position over time?
Well, Brian, the most important thing is making sure that the thesis, the reason that I invested in a company in the first place, is still on track. And that usually means waiting a few quarters to digest some new numbers and learn more about the company. Once I have enough conviction that the thesis is on track or might even be better than I originally hoped for, I might make a total of 2 to 3 purchases in a stock. Now, this is important. I try to never add to any position once it reaches 5% of my portfolio. That means that if I made a 2% allocation and that stock did fantastically well and it grew to be 5% in short order, I might only make 1 purchase. I like to stop at 5%, and a company growing has to do the rest of the work.
My philosophy is very similar to yours. Like you, I like to wait for a couple of earnings reports for me to confirm that my thesis for owning that company is on track. And if I want to make additional purchases, I tend to do so in 0.5% increments. Unlike you, once a stock becomes 3% of my portfolio, that's when I stop buying. I won't sell it. It's just at that point, it's up to the company to do the heavy lifting of making it a larger percentage of my portfolio, not my personal capital. One other thing I try to do when I'm building a position is do something called buying at better and better value points. As an example of that, between 2010 and 2015, I was personally building a position in a company called Mercado Libre, ticker symbol MELI. This chart shows the price that Mercado Libre was trading at during this 5-year period. You can see it was going up and it was going down, but the overall trend was up and to the right. During this period, I was personally buying Mercado Libre at several different times. Why? Because the company's thesis was clearly on track. If you look at any of the company's key metrics, revenue, customers, items shipped, etc., they were all trending in the right direction rapidly. So while my purchases were made at various times during this time period, importantly, I was trying to get this company at better and better valuations over time. Let's change this chart away from showing the company's stock price to showing the company's price to sales ratio. While Mercado Libre's stock price was going up during this time, its revenue was actually going up at a faster rate. For that reason, the company's price to sales ratio actually declined, even though its stock price was rising. What I was trying to do with each of my follow-on purchases was to buy the company at a lower valuation than I got with my initial purchases. Now, what you see here wasn't exactly my purchases, but it embodies the idea beautifully. With my first purchase, I got in around 15 times sales, and what I was trying to do with future purchases was lower the valuation that I paid for that company. There's two ways that can happen. First, the stock price can decline. Second, the stock price can stay flat or even go up. However, revenue would have to grow faster than the stock price is going up. In either instance, I'm trying to time the valuation of the company, not just the price itself.
Which leads us to our next big question. What happens if you do hook a great investment, but it becomes too large a percentage of your portfolio? For my own portfolio, I start paying attention once one stock is at least 15% of the overall holdings. I'll monitor it then, and if it reaches 20%, that's where I'm gonna start trimming no matter what. Importantly, if I ever need new money to make a purchase or for life expenses, I will take first and foremost from this position that's already reached 15% of my portfolio.
I do something similar to you, Brian. If I think a stock is very high risk, I'm going to try and cap my exposure to it at about 10% of my portfolio. Conversely, if I believe that a business is a very low risk business, I'll allow it to become 15% of my portfolio before I would start to trim it.
That leads to the age-old question, how do you decide when to sell a stock for any reason?
Knowing when to sell is one of the most difficult questions that any investor can face. However, we have a couple of guidelines that we think can help out. Before we get to that, we wanted to thank this video's sponsor, which is Quarter. Quarter's mission is to make every action between companies and investors meaningful. Quarter does so by providing frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world straight to your pocket for no cost. If you're interested in giving Quarter a try for free, visit the App Store of your choice and search for Quarter. That's Quartr. Thanks, Quarter, for sponsoring the video. All right, Brian, let's cover the reasons that we think you should consider selling.
First and foremost, if your thesis changes, that is a sign that you should think about selling a stock. There are a lot of different reasons why your thesis might change. The important thing to know is that if it does, it might be time to take action.
The second reason to sell is in a category that we call emotional reasons to sell.
That includes things like losing sleep because an investment is too risky for you, or losing interest in following the company at all, or like we just talked about, needing to rebalance a stock because it's become too large in your portfolio.
A third reason to sell could have nothing to do with the business or the stock itself and could actually have to do with just paying taxes.
This includes things like tax loss harvesting, particularly at the end of the year, or re-upping your cost basis for what you own.
I've personally sold out of losing positions in companies just because I was interested in lowering my tax bill. That's a perfectly fine reason to sell. And the final reason that we think it makes sense to sell is when your priorities need realignment.
By that, what we mean is your life changes, and as it does, your priorities will. So you might decide that money's better off somewhere else. You might need that money within the next 3 years, and if you're moving closer to retirement, you might want to hold more conservative stock.
One of the biggest traps that investors can fall into when they're thinking about buying, selling, or allocating capital is they often think in terms of binary, black and white decisions. It's yes or no, it's all or nothing. However, we don't think that's a helpful framework.
Yeah, it's a really easy trap to fall into when you're investing, to see things as black and white, but that's not how life works, and it's really important to be able to see the gray.
Just about everything that has anything to do with investing is filled with nuances. It's important to develop guidelines for yourself and to do your best to use those guidelines as North Stars for decision making. That's about as best as you can do.
One of the key tools that we have both found that helps us to see that nuance and that gray is to use an investing journal. When you use a journal, you can write down your reasons for buying. You can also write down some of the things that might make you want to sell a stock. And by going back and revisiting this when you need to make a decision, you can become a better investor by learning more about about yourself and the companies you're investing in.
I've personally been using an investing journal for many, many years, and I force myself to write down what I'm going to do before I do it. Taking the time to do that can really pay off and can prevent you from making the same mistakes over and over again. We hope you found this video helpful. How do you build your investment portfolio? We'd love to hear it in the comment section below. Brian's out.